The U.S. economy surprised to the upside for the second quarter as the nation's GDP grew faster than expected and almost every major category showed positive growth. There had been some signs of a slowdown in previous data that raised concerns, and we're going to look at that in today's video as well. But this latest report shows that a recession for the U.S. economy is nowhere in sight for the immediate future. Let's get into it. The performance of the housing market doesn't happen in a vacuum. It depends heavily on what is happening in the overall economy, and that's what we're looking at today. Let's get right into the latest government report for the U.S. economy. On July 25th, the Bureau of Economic Analysis announced that U.S. real gross domestic product grew at a 2.8% annualized rate, up from the lackluster 1.4% rate in the first quarter. This was also in line with the average growth for GDP over the last 2 years. What was perhaps the most important part of this GDP report is what it showed for consumer spending. After a concerning slowdown in the first quarter, personal consumption expenditures increased at a 2.3% annual rate, up from the 1.5% rate in the first quarter. This was also up slightly from the 2.2% average growth over the last 2 years. If consumer spending had come in at or below that 1.5% we saw in the first quarter, it would have been a big warning sign, given that consumer spending makes up more than 2/3 of the U.S. economy. As I mentioned in previous economy update videos, the average American consumer is not in real great shape right now. Almost half of American households have less than $500 in their savings account. The personal savings rate was 3.4% in June, the lowest since December 2022, and well below the pre-pandemic average of 6.1% from 2009 to 2019. The delinquency rate on credit card loans at commercial banks has been on the rise. At 3.16% in the first quarter of 2024, it is the highest since the fourth quarter of 2011. A recent study released by the Federal Reserve Bank of New York pointed out that rising delinquencies are happening most for people that are maxing out their credit cards. The last few years of high inflation took their toll on the average consumer, so seeing the relatively robust consumer spending numbers in this latest GDP report was much welcome news. Let's take a look at how the other sectors fared in the second quarter. With the exception of international trade, all major components of GDP made positive contributions to growth in the second quarter. Private domestic investment, or business spending, was boosted by an increase to inventories. One of the big drags on growth in the first quarter was a negative change to inventories, but as I highlighted then, we were likely to see a positive change to inventories as it had been negative for the last 2 quarters. This is part of the normal ebb and flow of doing business. Companies draw down and build up inventories over time. Imports were a big drag on growth this quarter, shaving off nearly a full percentage point off the headline number. Overall, it was a very good GDP report. Despite the higher interest rates we faced this last year, the U.S. economy has fared well, and right now there is nothing on the immediate horizon to suggest a recession is imminent. As I mentioned before, there are some signs of a slowdown, particularly in the labor market. While job growth has been positive, there was a notable slowdown in the pace of job creation. Here's a graph of the monthly change in total non-farm employment for the U.S. You can see that over the last few years there has been a general downtrend, but a lot of that has to do with the high job creation numbers that were happening as a result of a rebound from the job losses in the first year of the pandemic. It seems to have flattened out the last year or two, but the monthly numbers are a bit volatile. To get a clearer picture, we can take a look at it on a quarterly basis. Here's the monthly numbers averaged quarterly. For the second quarter of 2024, monthly job creation averaged 177,000 jobs, down sharply from the 267,000 jobs in the first quarter. But what's more notable is that this is the lowest number of average monthly job creation since the onset of the pandemic. It shouldn't be too surprising that job creation is slowing down. That is something the Federal Reserve has tried to do by lifting interest rates. It's pretty hard to bring down the rate of inflation through interest rate hikes without causing a slowdown in economic activity. Those interest rate hikes were the very reason that many people feared we would have a recession last year or this year, but hasn't materialized. We'll definitely want to keep a close eye on the labor market during the third quarter. Just recently, we received a disappointing jobs report for July, which caused a lot of concern on Wall Street when the report came out. It didn't put the third quarter economic data off to a good start. But the latest GDP report shows the economy is resilient. Consumer spending has remained positive and is in line with historical averages, despite the vulnerable state of the average American consumer and the inflation we've faced the last few years. Some people feared that a collapse of the commercial real estate market would trigger a banking crisis and a recession, but that hasn't materialized either, as I pointed out in my last video on that topic. I'll be releasing another update on the commercial real estate situation in the next few weeks, as well as other updates on everything happening with the housing market and the economy. If you want to see my next video when it comes out, make sure to hit that subscribe button down below if you haven't already, and hit that notification bell so you know right away when my next video comes out. As always, don't forget to hit that like button on your way out as well to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.